Good morning, good afternoon, good evening. It's New Year. It's January 6th, Saturday, 6:31 a.m. And welcome to the latest episode. This is Mark you.
And this is Wawi Santos. Good morning, good evening. Hello, everyone.
All right, we're at the latest episode, recording now, episode 95, Santa Claus Rally.
2024.
Oh yeah, 2024 first episode with a bear in the background. Episode 95, Santa Claus Rally fail. So was it a fail? So by technical definition, it is. Because usually the Santa Claus rally, according to the Stock Traders Almanac, it starts with the last 5 days of the year and ends with the first 2 days of January, first two trading days. So fails. Yeah, according to Market Watch, it's not only us that's pointing this out. According to Market Watch, uh, failed to stage the Santa Claus rally, the stock market itself. So usually the market goes up during those period that we just talked about. Um, yeah, usually the market average return for those days are 0.2% up. But this time around, the S&P 500 fell 0.9% during the Santa Claus rally. That was the worst performance for the Santa rally period since 2015 to 2016. In fact, the Nasdaq Composite, the tech-weighted heavy index, it's actually down 2.5%. And it's only the Dow Jones that's positive with a little bit of green, 0.1%. So if you check the Santa Claus rally here, it's actually down for those major indices. Here's when there was no Santa Claus rally tended to precede bear markets, or times when stocks hit significant lower prices later in the year, according to Stock Trader Almanac, Jeff Hirsch. He's the editor. So that's a red flag or warning indicator, and one of the major reasons why we have this big bear, grizzly bear, in the background. So if you guys have been following us closely for since November, late November of last year, we have been having the bull as our major background. But right now, it's a clear warning sign. A lot of Wall Street analysts are still projecting recession, but some of them are already projecting new market highs by December of this year. 5,100, 5,500, 5,300 projections. So I don't know. Tom Lee is also positive, obviously, but
hmm
I don't know. What do you think, Wawi, about this weak performance in the Santa Claus rally?
Well, some people attribute it to profit taking,
Mm-hmm.
but I still, would be looking for margins of safety. There's still a chance that we could end up in a recession.
Mm-hmm.
Uh,
Yeah.
there's still a lot of things that are unpredictable right now.
Right. The technicality is the S&P 500 did not make any good impression on that not so much significant period, but prior to it, the market has been rallying like 9 weeks in a row. So you're right, Wawi. It could just be a plain old um, sell the news or something like that to enter the year. So, but nonetheless, we have that clear definition from the Stock Trader Almanac, and we'll see how it goes. So, for the regular weekly sentiment survey, American Association of Individual Investors, a lot more people are bullish as of a couple of days ago, 48.6 from 46.3 a week prior, and a lot less bearish. So these people, including me, I guess, were bullish coming into this year just because, the market has been rallying. But to my dismay, I guess, this finding that we just discussed, it's not a good really indicator of the sentiment. The market isn't reflecting the bullish sentiment of the stock investors anymore. But not like anymore, but yeah, that's true. That's true. Like a lot more investors are bullish heading into this year, but the market doesn't reflect that. Uh, Fear and greed index still shows greed, but the market also, has been relatively down since the start of the year, and it's just January 6th. So for the fear and greed index, we're at 74 points, whereas a week ago, 75. So not much change there. We're still greedy, I guess, at this point. The market momentum, it kind of inflected on December 28th, just before entering the new year. So we were at up there at the highest. That's the highest that we have reached since a year ago. And now we have downtrend quite a bit. We have fallen 4783 to 4697, 478. We have fallen 219 points since we've reached this peak, but we're still quite a ways from the 125-day moving average, which we kind of like really look at as a threshold. If that crosses heavily down there, that's a warning sign. That would have erased the gains since November 8th we have made consistently in the positive side of things. So there's just one thing to watch out for. The stock price strength as well has slowly declined a little bit, but still above 5%. Then call options, look at that. It's slowly going up. It's still below 1, but it's above 0.8 now. We haven't been in that position since late November, since we started the rally. So right now, rally is slowing down, and a lot of investors are buying put options to protect their portfolio. And for the volatility, a little bit of spike, but it still hasn't reached the 50-day threshold yet. Just a little bit of breakdown in some of the what do you call this? Some of the indicators that we follow closely. But in terms of sentiment, you could tell, well, yeah, people are still greedy, right?
Yeah, the market is still exuberant and bullish in their positioning. But it will come to later in this month that we can determine how things are gonna head as far as company earnings. Company earnings should be pressured
True.
unless uh, they can recoup some of their losses through layoffs. There's been a lot of news about companies laying off workers.
Hmm.
Some members of the Magnificent Seven are laying off workers, including Google. Um, so they're trying to adjust to the pressured earnings. So we will see by the end of this month how these companies are faring.
True. I think Google still has been, what do you call this? Has introduced a massive move since last year about laying off. I can definitely remember when Facebook announced a massive focus on their margins or profitability. So I think there's a
There's
website, layoff FYI or something. Oh, sorry,
Mhm.
go ahead.
Well, because of what happened during COVID, they overhired people, hired a lot of people and kept them, you know, even though they don't need them anymore. But now they're seeing the pressure and they're having to lay off people. And a new trend I've been hearing on the news is there's some ghost jobs as well. They're posting jobs, but they really don't have a intention to hire. And this is just to show some strength of their company, like to make people think that they're still strong and still hiring, but they're actually not hiring.
Mhm.
So this is a sign that most of these companies are under pressure right now.
True. Well, this website here that we just pulled up, it's layoffs.fyi, and it's free for everybody to use. It's pretty interesting. So we're gonna take a look back on 2022 at first. So this is just focusing, I guess, in tech companies, but so 2022, 1,064 tech companies laid off 164,969 in 2022. In 2023, the year of efficiency by Mark Zuckerberg, 1,184 companies laid off 262,242. So if you're going to do the math, that's 100,000 employees
Hmm.
more being laid off last year. And so far this year, we have 6 tech companies already announcing 314 layoffs. I want to see a chart more like year or year, but I don't think we're gonna be able to pull that up. In terms of CNBC highlights, looks like so far this year only Alibaba, Lazada actually, fresh started with a fresh round of layoffs this year. So I wonder how much they're gonna lay off, but yeah, I don't see any specific numbers. But Lazada is a major player in the Philippines, as I have heard, because they're kind of good with their shipping and all that. So they operate mostly in Southeast Asia, Singapore, Malaysia, Indonesia, Philippines, Thailand, and Vietnam. So yeah, layoffs definitely. But yeah, regardless, we had the employment report yesterday, right, Wawi?
Oh yeah, it was unexpected for me
Yeah,
that it would trend, the employment will trend higher.
right, right. So the report actually surpassed expectation as of for the month of December. Um, Actually, we have the breakdown here in a second. So U.S. economy adds 216 jobs, shocking Wall Street. So U.S. economy ended 2023 on a high note. It's up from 173,000 in November, 216,000 jobs, while Bloomberg economists expected 175. So that's a pretty strong response during the holiday period. The Bureau of Labor Statistics also released 3.7% for the unemployment rate, flat from the rate seen in November. The experts were predicting a little bit of a tick up to 3.8%. So I don't know, soft landing or not? What do you think, Wawi? Are we on track?
Well, the hiring trend was during the sales season, so I don't know how many of these workers are temporary workers. I don't know exactly, but you should see that trend up. But I was surprised by the amount of people that was employed during this season.
Right.
But I guess they needed to catch up with their sales and have more staff in place. So we should, hate to say it, but expecting a rather sharper downtrend uh, with the
Right.
jobs report this month.
Yeah,
That's just my expectation.
right. And the market kind of react okay with it. It didn't sell off. It didn't sell off on a good news sell off and bad news rally as of yesterday, but they're kind of positive, 0.18% for Friday.
Well, that's in track with what the Fed kept saying that their job is to keep the strong job demand and keep inflation in check. So that's in line with their objective.
Mm-hmm. True. Pay increase gap switchers. So as well as there's another addition here on Yahoo Finance. The pay increase gap between job switches and job stayers have narrowed already. So about between 2022 and 2023, if you switch jobs, you can get more. Until now, you still can, but it's from 8% now when you change jobs. And if you stay, there's 5.4% increase possibility on your current job. Whereas around July of last year, you could have gotten 16% increase in your pay when you switch, compared to 7.7% if you stayed.
Well, excellent input there, because that tells us that, we're on track for slowing job demand then.
Mhm. So this is a post from Zero Hedge that I saw in X yesterday. Interestingly, so he's saying full-time workers plunge 1.5 million people in 1 month to its lowest since February 2023. Part-time workers soared 762,000 to the highest on record. Multiple job holders hit all-time high at 8.5 million. So that kind of got me into digging, and Trading Economics has good data. So it says here, full-time employment of the US decreased to 133,000 as of December from 134 November. So if you're gonna do the math there, 134,727 minus 133,196. Yeah, that's 1.5 million drop, which is accurate. So that's for the full-time employment. So it's not a big dip actually at this point in time, but in the recent history, we were just there a few months back, like what he said, February of 2023. So on going to the next, he said part-time workers did increase from 27,032 to 27,790. So 790 more part-time workers. So I guess that's where I'm not getting the same information as he is. And where's the other time? Multiple job holders. I can't find the exact data on the multiple job holders, but this is as a percent of employed. So right now we're at, and even this is for November. So, but take this with a grain of salt, everybody. Multiple job holders hit all-time high. So it's not fresh new employees, but it's like when people already having jobs, taking lots of jobs. So I don't know if that's accurate, then probably a lot of people could eventually find it tiring and work fatigue and just altogether succumb to the credit debt or credit loan that we have been achieving in recent time. What do you think, Wawi?
Sign of the times, I guess, with the higher prices of everything. People are having to have more than one job to pay their bills. And again, it's going towards the holiday season, so they're probably trying to get more money into the holiday season. So again, I would expect a trend down in January with regards to that hustle job market.
Right. Everybody gotta hustle.
Everybody's hustling.
Yes, sir.
That's good. That's good.
The S&P 500 for this week, like what we have discussed, is down negative 1.79%. The volatility, it's up 6%. So kind of like a response here. Whereas just a week ago when we were recording, the VIX was kind of positive, I remember, and the S&P 500 is kind of positive too. So they kind of, for some reason, didn't follow that inverse proportion for last week. Maybe people taking holidays, traders taking holidays, and so it didn't kind of jive for what it should be working for. So right now we could see the total inverse proportion that's taking its place, taking back its place from the holidays. VIX up, market down. The volatility for the Nasdaq, it's up 3.8%, and the Nasdaq is down 3.81% as well. Wow. That's perfectly correlation right there.
Mm-hmm.
3.8 for Nasdaq volatility, down 3.81 for the Nasdaq Composite.
It's very sensitive to the yield too. We had a brief jump in the yield yesterday, Wednesday or Thursday.
Right. Oh, we're gonna take a look at the 10-year, 2-year yield inversion too in a second. I think it's this one. All right. Speaking of yields, the 10 and 2-year yield for the past 5 days. Okay. It became less inverted, everybody. Negative 0.339. So, our theory kind of is working here, because as the yield curve is uninverting, this could happen if the lower end or the shorter period goes lower than the longer end, like the 2-year end going down,
Mm-hmm.
and then the 10-year going up, which is normal, supposedly the normal curve. But for the past, I don't know, how long has it been since we're negative? Here we are. Since this date. Since July of 2022, we have been negative. But look at this. Looks like we have bottomed back in June of last year. Negative 1.06. And right now we are negative 0.34. But yeah, definitely for the past 5 days, we are slowly uninverting. And the market kind of reacts negatively to that. So there's something to keep an eye on. Like what Wawi said, was it the 10-year yield that bounced pretty high, or?
Yeah, it bounced up. I can't remember, but it bounced maybe 0.08. I'm not sure.
Right. And if you're gonna take a look at the sectors as well, the market is telling us something here, Wawi. Market is telling us something here. Just for the past week alone, when people are back at work, trading, and projecting their outlook for this year, definitely they are respecting the positioning for a recession. So
Mm-hmm.
the top 3 or top 4 best performing sector just for the past 5 days alone, when we are experiencing some sell-off. Number 1 is healthcare. Number 2 is utilities. Number 3 is the energy, and a negative for consumer defensive, but the rest are negative. The worst performing sector for the first week of this year is technology, negative 4.78%, and consumer cyclical. So how long will the profit taking take place? We don't know, but the market is telling us something here in terms of positioning. We're going to look at the fund flows too in a little bit. Let's see where the money is really going. So it doesn't make sense to look at year to date or half year performance, because we're in a new year. Well, I guess for the past 3 months, you could tell utilities and real estate. I can't believe utilities in the second best performing for the last quarter. Well, by financial. I guess you mentioned Wawi in normalizing rates, financials will be a good bet, right?
Yes, yes. Materials as well,
Mhm.
industrials.
And they are definitely in the past 3 months, including real estate,
Mm-hmm.
where the money or where the outperforming sector has been going. So luckily we are able to pull off the Reuters fund flow report as of yesterday. So I guess they publish on Friday, but sometimes they do
Mm.
on Saturdays too. So it's kind of tricky. But it's good that we have this included in our recording today. So according to Reuters, global money market funds see big demands as rate cut euphoria fades. So they're already indicating the euphoria is fading despite our findings that there are more bullish investors as of a couple of days ago, and we're still in greed territory. But let's take a look at their report as of yesterday. So investors move a lot of money into money market again in the 7 days leading to January 3, as they become cautious of the key employment reports. A massive $111 billion net came into the money market funds. So that's a big spike for the past 4 weeks. Money market, it's back in the game. So after some outflows since last month, money market is attracting more money. So US employment obviously is still resilient. So both US and Europe money market witnessed an aggressive buying. 56.9 for the US money market, 56 for the European money market. The Asian money market, however, witnessed 3.86 billion of outflows. I don't know what's the difference between US and Europe and Asia money market. I just know Asia is maybe China, but China should be having higher rates at this point because of their decline in performance. As we have talked about in the group, Hang Seng Index itself is just recorded its fourth year of decline. The whole index decline for the fourth consecutive year. So that's just bad for investors in Asia. Regardless, global stock funds recorded only 230 million. Oh, sorry. Global stock funds recorded 230 million of outflows after receiving 15.95 billion of inflows during the Santa Claus rally period. So actually a lot of money tried to catch that ongoing 9-week rally in the Nasdaq and the market. And unfortunately, the 15.95 billion have seen a decline of well, this is global stocks, so I'm not sure how much of that $1 billion went to the US, but it has underperformed since they poured their money in the US stock market. Okay, in terms of sector, so sector industrials led the outflow. A lot of money came out from industrials, followed by net selling in metals and mining and healthcare. Interesting. So 292 left the industrials, 247 left the metals and mining, 242 left healthcare. Interesting. Whereas healthcare is actually the number one performing sector. So you can tell here that it doesn't mean that the money is leaving, that the sector would underperform. So I guess it depends on Mr. Market. Whatever he decides, we reap the benefits or the the loss. But money has left a little bit, $250 million left industrials, mining, and healthcare. Bond market. Okay, global bond funds received 9.7 billion a lot of money poured into bond funds. The most significant week inflow since December 6th. The corporate bond funds, second consecutive of buying, $1.5 billion. US short-term, okay. I don't know. We don't really, I myself, I don't pay attention to short-term bond funds. What do you think, Wawi? You're
Well, I
short.
don't have any bonds on my portfolio. In
True.
fact, in fact, I'm using utilities, dividends instead of treasuries right now. But I'm seeing a trend where investors are going to short-term treasuries.
Yeah, like a TLT, right? It's
I'm not familiar with TLT, but yeah, I think it's good to position some of your portfolio on bonds.
yeah.
But
Yeah, it's not short term. It's 20 years. I don't know what short term is. Oh, here, 1 to 3 year. Good thing Google has this option.
yeah, I'm talking about, about those.
They're pretty steady. Negative 0.07. I mean, very little gains, very little performance. I don't even know their yield at this point. Here, iShares is the one that issues it. So just for curiosity, let's see how much it is yielding. Portfolio characteristic, 3%. So at this point, I don't know. Risk-free is 5.25%. No wonder people are pouring their money in the money market. I mean, if you're gonna buy 3% yield, you might as well go for the
Mm-hmm.
money market where your money is just parked there and earning yields. So, but still, we are discussing the bond funds. So 3.2 billion first weekly inflow into US short-term bond funds. High yield bonds globally experienced their net selling, 108 million selling. First weekly outflow in 3 weeks. Investors pulled they pulled nearly $1 billion from precious metal fund, breaking their 4-week long. So this is about gold, precious metal. People are selling gold right now. Energy funds, energy has been worst performing since past 12 months. So I'm not surprised people pulling some money, only 20 million. So emerging markets, both equity and bond, attracted inflows for a second straight week. Wow. A lot of money going in there. 1.5 billion and then 1.59 billion going to emerging market equities and bonds. Okay, that sums up the fund flows. Good thing we're able to pull it up this week, which is very helpful. It doesn't really reflect what the market is teaching us or providing us returns, but it definitely gives us overall like bird's eye view where the money is going, what people are doing, the experts are putting their money. So according to Bank of America, investors kick off 2024 with 123 billion record cash shift, according to Bank of America. So this is what we just highlighted. A lot of money is going into the money market fund, the safe haven area. In addition to that, Bank of America says investors bought 10.6 billion of bonds, 7.6 billion of stocks. They did shed 0.8 billion of gold. So I guess gold is supposed to be a safe haven, right? Why are people selling gold then?
Well, I think they're becoming more bullish sentiment moving forward. Most people are predicting a brief recession, so
Right.
so they're pulling some of that and probably putting it in money market, like you said.
A little bit safer than gold.
Safer than gold. Can you imagine?
Energy stocks, so okay. Energy and oil haven't really been performing since last year, so this is no surprise. 7 straight week of outflows. US small cap recorded a weekly inflow of $2.3 billion. 5th weekly inflow in a row. So a lot of money still piling in the short in the small cap. We're gonna look at the Russell index. It's down 5% as well. The small caps. Well, is it way worse than the Nasdaq? Yes, it is. So Nasdaq has experienced quite a sell-off too. Another 5% more. That's going to be a short-term correction. So just the website we were able to pull up Hedge Follow. Largest 1 week sellers so far this year. Taking a closer look. AAII Group, T-Mobile, nearly 95 million being sold by Deutsche Telekom. Let's see what the big names here are. Coinbase as well. Total of 25.6 million have been sold just in the past 5 days. Lots of insiders. Eshram, I don't know who that is. Andreessen Mark, Armstrong Brian, which is the CEO, I believe. Airbnb.
He's the CEO.
Airbnb 21.7 selling. Chesky Brian, Nathan Blood, I don't know how you say. Dave Stephenson. ICE Exchange, MongoDB. So I guess it's just good to highlight more than 10 million selling, starting from this year's first recording, just following major sellers. MongoDB, Regeneron also. George Jacopoulos selling a lot, 15 million worth. Colpart, which is an industrial. Englander Daniel sold 15 million. Salesforce 14.6. Mark Benioff selling 11 million. Netflix, Reed Hastings, founder CEO, sold 12.2 million. I guess Lam Research, another big company. 3 insiders selling. Palo Alto, Zucknier sold 10.39. MicroStrategy, Michael Saylor, 9.95. So we're just going to cut off around 10 million. So Elf Beauty, Eli Lilly, 9 million worth. So it's a good website. I think we're going to have to start including to our recording. Oh, so Wawi, we have less than 1 minute left. We want to avoid what happened to us last week. The abrupt disconnection. So I guess thank you guys for joining us for our first recording of this year. And this is our first time that we're going to use the bear as a logo. Thank you, Wawi, for joining us, sir.
Thank you, Mark, for getting all that nice input and data for the group. Happy New Year to everyone. 2024 is here.
Yes, sir. Happy New Year, guys. Thank you, guys.